Welcome to the 23rd edition of the Hindustan Times Leadership Summit. Today we have with us Ridham Desai, a Managing Director at Morgan Stanley, and an equities market veteran, somebody who has been bullish about Indian stocks for quite a long time. Thank you, Ridham, for joining us today and having this conversation at the HT Leadership Summit.
Thank you for hosting me. It's really lovely to be on this show.
So let's dive straight in. In your latest note talking about the outlook for Indian equities in 2026, you have said that Indian equities will regain their mojo this year. I'd like to know what makes you so confident.
Okay, so let me just step back a bit and explain why we've had a difficult trailing 12 months. Now, it may not seem so when you look at the Nifty or the Sensex because both have been notching all-time highs. But the fact is that the world around us has been in a ferocious bull market. So if you look at the top 20 markets by, say, market capitalization, India has been the 20th or worst performing market. And everything around India is up between 20 and 70%. So this is staggering amount of underperformance. In fact, in US dollar terms, India has had its worst relative year since 1993. So let's keep that in mind. The absolute level of the Nifty, kind of masks that underperformance that India has suffered. Now, why did that happen? I think the proximate reasons are three. One is coming into the September quarter last year, India started facing a slowdown in its economic growth, which I think was a combination of both tightness by the RBI in terms of policy, rates, liquidity, and regulatory burden on the banking sector, as well as the fact that government expenditure slowed down due to idiosyncratic reasons, elections, heavy rains. So when we arrived in October, India's growth started slowing down. I term it as a mid-cycle growth slowdown. It wasn't the end of the cycle. We had actually done quite well in the preceding 3 or 4 years, and we were experiencing a mid-cycle consolidation. And the other reason was that India's relative valuations versus emerging markets, a cohort that India is usually compared with, were at all-time highs at the end of September last year. So clearly the valuations were not favoring India. We saw some policy pivots in China. And then as we entered into 2026, the world migrated into a massive AI trade. And India is striking for its lack of any direct AI play. So the thing that investors, especially tourist money around the world, wanted to buy was AI. India didn't offer that. So these were the reasons. Now, as we look forward, in fact, India's relative performance is already turned in the month of November. We've beaten the index by about 300 basis points. So we're recouping some of our lost ground. And this has come on the back of a big policy pivot that India itself made, starting in February with rate cuts. Then in April, with both a rate cut as well as a CRR cut, which, by the way, has happened only twice in India's history, once during in the aftermath of the global financial crisis, and then the second time during COVID. April 2025 did not represent any such crisis. So it was quite an exceptional move by the central bank. And the central bank has backed this with massive doses of liquidity, as well as easing of regulatory burden on the banking sector. Now, I may just pause here and tell viewers that India's growth has already started to turn. And if you look at the bank credit growth in the month of October, consumer credit has already accelerated from a low of 7% to near about 17% ex-mortgage. So the policy that the RBI put out already started making its way into the economy. The government has then backed this with a slew of reforms, which I will not recap here because I think everybody knows GST and a lot of other things that are happening. And so I think the growth slowdown is behind us. We're seeing this in real growth data, but frankly, from an equity market standpoint, we need acceleration in nominal growth because that is what earnings depend on. So nominal growth has still not moved, not at least till the end of September quarter. But I reckon as you go into 2026, we're dealing with nominal growth, which will be into double digits, which will then be accompanied by a pretty strong recovery in earnings. I dare say India may actually be the first growth in the world in terms of earnings, let alone GDP growth, which we know India is already the fastest. The second thing is that the valuations have corrected. So if you go to October, because we moved a bit in November, but at the end of October, India's relative valuations were near about all-time lows. So from all-time highs, we've gone down to all-time lows. And while I'm not an expert on global AI trade, I think a lot of it is in the bag. And at the margin, I think that trade is likely to attract less capital, less tourist money. So it's less of a headwind for India. So put all of this together, I think it is looking like a very exciting year for Indian equities.
Great. That was a detailed answer. There are one or two threads from that which I would like to pick up. One is, you're talking about this, the investments which were flowing into global AI stocks now not being much of an headwind. But on the flip side, I mean, do you see that as some kind of a bubble? What will be the effect of such a bubble sort of imploding, and what will be its effect on Indian equities? Would you look at that as the biggest risk?
Yeah, I think the biggest risk is a slowdown in global growth, which incidentally we're not anticipating. It's not our base case that India's growth will slow down. Global growth will slow down. It will slow down a little bit, but not a lot. And just allow me a moment here to explain why, because this is very important, I think, for people to understand. So we're entering into 2026 with unprecedented stimulus across all the major economic zones, whether it's the US, both fiscal and monetary, Europe, both fiscal and monetary, Japan, largely fiscal, and China, both fiscal and monetary. This has not happened since 2008. So in response to the global financial crisis, we had synchronous policy stimulus across the world. And then since then, the world has had asynchronous policy responses. This policy response that is coming is largely in response to the tariff that the US has been levying across the world. And economies are taking idiosyncratic decisions to protect themselves from the after effects of these tariffs. So the resultant thing is that we're entering into a period with pretty large stimulus. India has already done its thing in 2025, but others are actually also continuing to do this in 26. So the downside to global economic growth seems contained. Without this stimulus, we probably may have got a lot more downside as a consequence of tariffs. We're not getting it. So the biggest risk to India is that this thing does not work out and the stimulus falls short of requirement, and there is some untoward global event like a war or something of that sort, which then starts affecting global growth. India needs a little bit of support from global growth to ensure that its own economically powers ahead. So in my mind, that is the biggest risk. Now, on your question with respect to the AI so-called quote-unquote bubble, I'm not an expert on this, but I don't see this as a bubble as yet. Everybody is warning us it's a bubble. And just going by my experience with markets spanning 35 years, when everybody is calling it a bubble, it usually has more legs to go than we all think. So yeah, it may eventually prove to be a bubble, but it just doesn't seem we are there as yet. The markets are still fairly orderly. They've not become, completely crazy. They could get there during crisis, but it's not happened. Now, if we get into a bubble and it crashes, it will pull down stock prices everywhere in the world. The good news and the bad news is as follows. The good news is that India is a low beta market, so it will outperform handsomely. The bad news is that it will be hard to contain the downside in absolute terms. So then the Nifty will probably head towards our bear case rather than towards our base or bull case.
So, I mean, given such a scenario and your base case, for the markets to climb in 2026, What would you advise investors on gold? Would you say that an aggressive investor should still hold maybe 10% in gold as a hedge?
If talking about the AI bubble is outside my competency, gold is totally outside my competency. So I would not want to really go into the territory on what people should do with gold. But I'll just spend a moment here on explaining what's happening, and then people can make their own portfolio call. So I think the world is certainly looking for a new currency anchor. That doesn't mean the dollar is done and dusted. When the pound started experiencing its downfall, it took a good 40 years before it got replaced by the US dollar. So it's not probably happening in our lifetime. We don't know that. But I think that is the immediate reason for why gold has been so well bid. I think 2022 marked a very crucial event for the appetite for gold, because it was the time when there was embargo on a lot of Russian businesses around the world. And that's why central banks started diversifying. And their diversification, I think, has triggered this. So that's the story on gold. It is a long-term hedge on a shift in global currency dynamics, which may not have anything to do what happens in 26, 27. Of course, the fact that the Fed is likely to cut interest rates, and we're expecting the Fed to do 3 rate cuts in the next year, or in fact, in the next few months itself, by June itself next year, I think may also play on what gold is up to. And, similarly on Bitcoin. So neither of them represent any areas where I would like to go in detail, but I think these are alternatives that the world is hedging itself with against any adverse currency dynamics. And one more point which I'll make here is that they should not be termed as assets. For me, an asset by definition is something that yields an income. So equities yield dividend, bonds yield your coupons, fixed deposits give you interest, property gives you rent. Quintessentially, Bitcoin and gold do not yield any income. So they're essentially stores of value. They're not assets. And in your mind, you should keep that when you're making a decision that what you're buying is a store of value. You could be potentially buying a medium of exchange. Right now, neither of them qualify as such. But you're definitely not buying an asset when you're buying these two. The difference, if you allow me a moment, the difference is that when you're buying an asset, there is an assessment you can make about fair value, which is you estimate the future income from that asset, and then you discount it at your expected rate of return. You can do that for dividends. It's the hardest to do for equities. It's quite easy to do for bonds because it's a fixed duration and fixed coupons. And then you arrive at a fair value and you compare that with the current price and make a decision on whether you want to allocate capital there or not. With gold and Bitcoin, no way to assess fair value. The fair value is what the next person in the queue is going to pay for it. And that is not something you can estimate. You can only guess. And that's the difference between gold, Bitcoin, and the rest.
Do you see a continued supply of paper in the primary markets acting as kind of a ceiling against the markets rising consistently? I mean, of course, we have retail SIPs continuing, so that will give, the equity rally legs. But this fresh supply of paper, which seems to be coming, what are your views there?
So I just hope that it continues and it gains momentum. It's very crucial for the progress of this bull market that companies raise capital and invest. Investment rate of the economy is directly correlated with corporate profits. And in the early stages of an economic boom, which I characterize the current situation as, an investment rate usually goes on, and then it takes a while for these investments to turn unproductive and for the cycle to end. So we are nowhere there at the moment. Raising of capital is a signal that companies are willing to deploy balance sheet, which is so important to sustaining this growth. And by the way, the government has already signaled that it wishes the private sector take up the heavy lifting. Coming out of COVID, the government did most of the heavy lifting and took Capex higher, took the fiscal deficit higher, and is now clearly in fiscal consolidation mode. So the private sector needs to do that. So that's the macroeconomic angle. Now coming to the stock market perspective. So here's what's happening in the market. There is, as you cited, a daily bid that comes from retail investors who are, and we can discuss this question later on, but I see a structural shift in household balance sheet. So this bid is not going away. And this bid is something like this. Now, there are only two other players in the market. You have corporate issuers and you have foreign investors. The corporate issuance is coming in here. So this is the amount of selling that foreigners have to do in order for a trade to happen. Otherwise, this bid cannot be satisfied. This is what's been happening the last 9 years. Domestic bid, corporate issuance, foreign selling. Now, foreign selling to become foreign buying, corporate issuances have to go here so that this becomes foreign buying. So ironically, for the market, technically, if everybody is eagerly waiting for the FPI bid, the issuances actually need to accelerate. And just one last point on issuances. The trailing 12 months, we're sitting at about 1.2, 1.3% of GDP. So it has potential to triple from here without actually upsetting the secondary markets. So we have a long way to go before this happens. In fact, that will also signal the peaking of the investment rate, which also I think has some distance to travel.
But Ridham, many of these IPOs which are coming, those are just about, they are about giving early investors an exit rather than the money that is being raised used to finance new Capex. And we have been talking about a Capex revivals for at least 2 years now. Are there any tangible signs that you see that it is actually turning?
So two things here. Of course, there are investors who exit. That capital then gets reinvested. Net, I think we're still raising money abroad amongst private equity funds. And if you look at what venture capital and private equity funds are saying, they're actually increasing their commitments to India. So they all have a 7-year or a 10-year cycle in which they have to book profits in existing funds. But net, I think they're going to bring capital back through new issuances, new funds, and that will flow into other businesses which need that capital. So I don't worry so much about it. There's a small nuance to this about multinational listings, and that is not a very large amount of money, but those are truly exits. That capital may not come back. And that I think is okay. The country is very large. The economy is very large. It can bear that. But that's not the capital that is coming back. The rest of it will get recycled and therefore is good for growth. Recycling of capital is good for growth. So private investments have been crawling higher. The fact is that the investment rate to GDP is currently at about 31.5%. And this has come off 500 basis points from the previous cycle low. About 2/3 of it has come from the government and 1/3 of it has come from the private sector. I think the mix will now change going forward. We think this number can go to say 36% before it peaks out. And it's quite likely that the remaining 4.5% will come all from the private sector. So that mix is likely to change. And I think we're seeing that selectively in certain sectors. Now, some of this data has gotten distorted because the economy did go through a bit of a slowdown. And then the uncertainty arising from US tariffs has also hurt, I think, investment plans. But I expect these things to settle down with the government fully behind growth and the RBI fully backing growth. I think confidence to renew Capex plans will probably emerge in the next few weeks. In fact, I don't even think we'll have to wait for a few months.
This US tariffs has been one major factor, hanging over the economy and the markets for the past 12 months or so. How do you view the India-US trade deal that is in the making? I remember reading somewhere that you have argued that US tariffs really don't matter for India. Would you elaborate, please?
Yeah, sure. Yeah, so you see, I have not yet cited that as a concern or as a reason for the market's underperformance. But that's not probably what you will hear if you talk to foreign investors. So foreign investors seem to be very focused on this. And it's more a signaling than material impact to the economy. So that goods under the tariff announcement made by the president of the US has affected about 1.2% of India's GDP. So as such, it is not so critical for performance of the economy. But of course, that 1.2 can create a drag and want to have that drag of 30, 40 basis points. So we want to put that behind us. But it's not a catastrophe for India. Now I know, and we all know from what's coming out in the press, is that a deal is underway and it's probably likely to come through before the end of the year, which will take that overhang away. And that's in our base case assumption for 2026, that this overhang will cease. Foreign investors might be quite actually positive about this. And you'll probably get a little bit of a pop on the Nifty. But it's not changing the secular story, which in any case in India's situation is quite positive. So the US tariff deal is a good thing for India to have, but it has not been a problem so far for the market or for the economy as such.
What would be the themes that you would bet on, for the next decade or so? What are the big thematic stories that will emerge?
So see, I think we'll step back a little bit here. Why are multinational companies so excited about India? And the singular reason for their excitement is the consumer of this country. India has a unique income pyramid. It has cohorts running into millions of potential consumers in across income baskets, right from the bottom, where we still have a few very poor people living in sub-Sahara conditions, to the top, where we have 5 million households that can afford anything on the planet. This unique income pyramid makes India extremely attractive for anyone who wants to grow their business. And given our view that India is likely to account for 20% of incremental global growth over the next 15, 20 years, and probably that number is rising, not falling. If you, depending on what product or service you sell to your consumers, India could be between 10 and 100% of a particular multinational company's growth over the next 10 years. So it is unavoidable. Because India is becoming far more important for your business, do it out of a factory in India. And this essentially sets the stage for a manufacturing revival. And of course, it's backed by policy. So it actually helps a manufacturing revival. So keep this in the background. India enjoys a very strong position in the global market, is likely to attract a fair amount of FDI in the coming years, and is likely to see an increasing share of manufacturing. On the other side, India is the only country that has actually nailed services exports at scale. Nobody has done that. And if you look at the services traded globally, that's actually growing much more than the manufacturing trade. So last year, for example, the world economic output was about $105 trillion. 65 trillion was services, 40 was manufacturing. Of the 40, 24 was traded. So 60% on average of the stuff that people around the world buy is not manufactured at their home country. It is manufactured outside. Of the 65 trillion, only 8 was traded. It was about 4 trillion 10 years ago. So the share of services in global trade has actually doubled in the increased materially over the last 10 years, and the absolute number has doubled. Now, I dare say, given all the geopolitics that is going around, manufacturing share in total output traded share may not increase going forward, because more and more countries are seeking to rebuild factories in their home countries. Services, on the other hand, has potential to grow a lot. Of the 65 trillion, we reckon about 40 can be traded. There's some stuff that cannot be traded, like your next meal or your next haircut. But there's a lot that can be traded. So 8 can go to 40. Now, India's market share of this 8, ex-tourism, is about 6%. I won't be surprised if India doubles this share in the next 10 years. And if you double the total amount of traded services in the next 10 years, that's a $2 trillion export opportunity. It's a 5-fold increase from where India is right now. It is enormous, and there's no competition. China is nowhere close to doing this. Nowhere. Anybody else doesn't have the scale that India has. So when you combine these two big macro backdrops, I think the thing that you will find is that the Indian consumer will be the toast of town, and everything relating to consumption, I think, will do well. From a stock market perspective, of course, at any point in time, you have to pay attention to valuations. Because if you buy something very expensive, even if the business does well, you may not make money on the stock. So keep that in mind. But there are enough attractively priced consumer companies or shares that I think investors should look at. The second is, I think lending businesses will do also very well. India's starting point of private credit to GDP is somewhere in the mid 70s. And there's no reason for this not to go past 100 in the next 10 years. So lending businesses may actually outperform the economy. And the reason for this is there's been a dramatic psychological shift amongst younger generation. They're willing to spend their future, which older generations did not. My father did not. I have not done that. Now, this all ends very badly in the future, but that future is probably 50 years from now. The world, by the way, is grappling with this because it has spent its future away. India has yet to spend its future, but it will eventually. But when you spend your future, your near term actually gets better. Manufacturing, as I mentioned, I think inside that there are some interesting subsectoral opportunities. We're indigenizing defense. We're creating a supply chain in semiconductors. Shipbuilding is another interesting place. I think the whole electronic supply chain, because of the increasing home production of mobile phones, is another place to look at. So quite a few interesting manufacturing subsectors to look at. And finally, I'll just make one last point. Energy. I think it's a major theme. Last year, India consumed about 800 watts per person per day. That number compares with 9,000 in America. And it's a fraction of what the world does, especially the Western Hemisphere and China. And India's energy consumption is set to boom in the coming years. And that, I think, is going to lend its to great downstream opportunities as India's energy infrastructure gets created. So that's how I see sectoral opportunities.
Right. But energy in the short term, you seem to be not so gung-ho on it. I mean, are these valuation concerns or regulatory risks?
No, I don't know what you are referring to as energy here, but energy has got multiple buckets to it. So the supply of or the source of energy can be gas, coal, nuclear, oil. Oil is actually reducing share, so it's losing share. The others are gaining share: renewables, solar, wind. So there are multiple sources. So I think, you may be referring to oil here, which we are kind of less constructive on oil because we don't think oil prices are going anywhere next year, which, by the way, is good for India's macro at the margin. But that's different from what I'm talking about. We're talking about the whole downstream, which includes energy infrastructure, which includes all the investments around energy, making it more efficient, making it more available. And if you allow me, the SEB reform that the government has proposed, I think could be a game changer. Because if we can privatize even a handful of state electricity boards, the potential reduction in losses, the increasing efficiency, and the downstream effects of that, I think could, on its own alone, lift India's growth rate by 50 to 100 basis points. I mean, you don't need to do anything else other than that. That's how critical this reform measure could be.
Right. So those are the long-term bets you have. But in the short term, if you think that if money flows out of this US tech stocks, where will it flow into in India? Will it be IT stocks or will it be old economy sectors? How do you see that playing out?
I think banks are probably where it comes. Selectively in some consumer names. I think IT services is very interesting. It's been at the receiving end of the AI trade. For some reason, people think it's the anti-AI trade. I don't agree. I think Indian IT services companies will actually benefit hugely from AI, will not lose out. And their next leg of growth will be largely AI related. So if you are a patient investor and if you're willing to look through near-term underperformance, I think IT services is a very interesting place. But at the margin, I think the easiest thing for foreign tourist money to buy is banks. Large, liquid, easy to understand. And the banks are also quite inexpensive relative to their own history. And we're seeing a revival in earnings. So I think that's the easiest thing to do.
If you
Actually, when I say banks, I should say lenders because I don't exclude the non-banks. So I say the lending businesses are the easiest ones right now.
If you have to make one call for 2026, which will be totally contrarian to the rest of the market, what will it be?
Nifty up 30%.
I think the consensus is that, the markets are going to rise.
30% is a crazy number. And if you get that, I don't think it's in anybody's head right now.
Yeah, that is actually higher than your bull case also, I guess, right?
Around there.
Okay. And finally, one last question. What would be your word of advice for retail investors?
I think they are the smartest people on this planet. And they fully understand that equities is a long duration asset class. It is not meant for annual trading or monthly trading. And most of them don't do all that. It's just come in every month and buy some stuff. Keep increasing that allocation, especially if you're in your 20s, 30s, and 40s, because over 20, 30 years, the compounding of this will be enormous and will create a lot of wealth. So I think the best thing that retail investors could do, and by the way, they're doing that. So it's not really advice, but it's just highlighting what they're doing, is not losing faith. Understand that this country is on the throes of a major growth cycle, and equities would be the most beneficial asset class.
Thank you very much, Ridham, for this, taking the time out for this conversation.
Thank you.